We stand at the threshold of the most profound transformation in financial services since the invention of double-entry bookkeeping. The year is 2026, and artificial intelligence is transitioning from a tool that assists finance professionals to the actual decision-making engine of the global financial system. This is not hyperbole. This is the consensus view among chief financial officers, banking leaders, and technology visionaries who shape the future of money. The transformation unfolding right now will determine whether you and your family build wealth or fall behind in a world where machines make financial decisions faster and better than humans ever could. Finance chiefs broadly expect artificial intelligence, including agentic artificial intelligence, to shift from experimentation to proven, enterprise-wide impact, transforming the finance function with success depending on factors such as strong governance, clean and trusted data, modernized architectures, and human judgment. Marie Myers, Executive Vice President and Chief Financial Officer of Hewlett-Packard Enterprise, stated plainly that artificial intelligence is not on the horizon, it is here, and in 2026, artificial intelligence will move beyond experimentation to become a core enabler of finance operations. A November 2025 IDC study commissioned by Microsoft shows that frontier firms, organizations that embed artificial intelligence agents across every workflow, report returns on their artificial intelligence investments roughly 3 times higher than slow adopters. This 3 times multiplier effect will create a massive performance gap between institutions that embrace artificial intelligence and those that delay. Within a decade, the slow adopters may not exist anymore because the performance gap will be too large to overcome. The death of cyclical finance, the birth of continuous intelligence. For decades, finance has operated in cycles: quarterly closes, annual budgeting, periodic forecasting. Financial teams work frantically during these windows, then slow down between cycles. Artificial intelligence is ending this cyclical operating model forever. If 2025 was the year experimentation with artificial intelligence spiked, 2026 is the year finance leaders turn that energy into operating reality, with pressure increasing for faster cycles, sharper insight, lower risk, and the ability to adapt to whatever the next quarter throws at you. In 2026, inputs stop arriving at the 11th hour as tax, compliance, and financial planning and analysis begin to share structured, governed datasets. Forecasts start reflecting how the business actually operates rather than how spreadsheets wished it would, and regulatory logic gets translated into constraints that artificial intelligence models can understand with tax sensitivities feeding directly into scenario design. This transformation eliminates the massive inefficiency of cyclical finance. Forecasts update in real time. Risk models adjust automatically as conditions change. Tax implications flow through planning automatically. The entire infrastructure shifts from episodic analysis to continuous intelligence. Zane Rowe, Chief Financial Officer at Workday, stated that there has never been a more exciting time to be a Chief Financial Officer, with artificial intelligence unlocking new opportunities for value creation through unprecedented data and insights. But the shift will move from asking what artificial intelligence can do to how to build the foundation for scale. When machines negotiate with machines, one of the most disorienting transformations coming in the next few years is what experts call the zero-click world. By 2026, financial institutions will see human visits to their websites drop by 20%, while machine-initiated traffic surges by 40%, with consumers increasingly relying on artificial intelligence agents for queries such as best mortgage rates or how much to save for retirement. This seemingly simple statistic represents a fundamental restructuring of how financial services get distributed. Customers will no longer visit bank websites or call advisors for information. Instead, their personal artificial intelligence agents will negotiate directly with bank artificial intelligence agents, hammering out the best terms, comparing options across multiple institutions, and executing transactions, all without human involvement. To compete in this zero-click world, banks must invest in machine-readable content, real-time application programming interfaces, and transparent pricing, paving the way for an agent-to-agent economy where personal artificial intelligence negotiates and transacts on behalf of customers. The institutions that build this infrastructure early will capture market share from those that delay. The institutions that fail to build it at all will become irrelevant. When artificial intelligence stops asking permission, the single most transformative trend in finance for 2026 and beyond is the emergence of autonomous artificial intelligence systems that make decisions and execute them without seeking human approval at every step. By the end of 2026, Gartner predicts that 40% of business software will include artificial intelligence capable of completing end-to-end tasks independently, such as fraud detection, loan processing, customer onboarding, or reporting without human intervention at every step. This represents a fundamental shift from artificial intelligence as a tool that humans control to artificial intelligence as an agent that humans govern. The real winners will not be those with the best artificial intelligence models, but the organizations building systems that improve over time, powered by high-quality data, compliant processes, and infrastructure designed for production from day one. Frontier firms embed responsible artificial intelligence frameworks into every stage of the life cycle, from design to deployment and monitoring, with leaders integrating data privacy, encryption, and access controls across artificial intelligence innovation from day one. While Bradesco's bridge demonstrated how a bank can responsibly operationalize agentic workflows, achieving 83% resolution rates for digital service and a 30% reduction in tech costs. 1/3 of manual work disappears. The operational impact of artificial intelligence automation in finance will be staggering. In 2026, artificial intelligence will automate over 1/3 of manual processes such as data processing, reporting, and reconciliation, driving efficiency and accuracy. With Tier 1 banks moving beyond generic workflows to role-specific artificial intelligence agents for compliance, information technology coding, and contact center operations. When you eliminate 1/3 of manual work from financial operations, the implications cascade through entire organizations. Finance teams shrink, costs plummet, the freed-up capital gets redirected to innovation and customer service. Paradoxically, the institutions that automate most aggressively often improve customer satisfaction because the technology frees human employees to focus on relationship building rather than administrative burden. The new hierarchy of competitive advantage as artificial intelligence capabilities become standardized across institutions, the competitive advantage shifts from the models themselves to the data and governance frameworks that feed them. Domain expertise advantage emerges. As natural language interfaces eliminate coding barriers, the competitive edge shifts to the context and knowledge you feed into models, not the models themselves. This represents a fundamental shift in what it takes to win in finance. It is no longer about having the smartest PhD mathematicians building the most sophisticated models. It is about having the cleanest data, the most comprehensive governance frameworks, and the deepest domain expertise. A mid-sized institution with exceptional data quality and clear governance can outcompete a massive institution with sloppy data and unclear frameworks. When compliance becomes competitive advantage, the regulatory environment is tightening around artificial intelligence at the exact moment financial institutions are deploying it at scale. This creates an enormous competitive advantage for early movers who build responsible artificial intelligence frameworks. In 2026, proactive compliance is now an imperative, if not a competitive advantage, with regulatory complexity intensifying, meaning trust must be the foundation for scale and innovation. The institutions that view compliance as a burden will lag behind those that view it as an opportunity to build customer trust and avoid regulatory disasters. In 2026, generative artificial intelligence will evolve from content generation into structured, responsible decision support, with financial institutions already applying generative artificial intelligence to summarize cases, advise employees, classify customer intent, and respond to inbound communications with unprecedented accuracy. From worker to orchestrator, the most human impact of this transformation is how it changes the jobs of finance professionals. Collaborative robots, known as cobots, have transformed manufacturing, and in 2026, their principles are increasingly influencing service industries, including financial services, not as traditional, fully autonomous robots, but as systems designed to work with people, not replace them. The financial analyst of the future will not be someone who manually builds spreadsheets and writes reports. They will be someone who orchestrates artificial intelligence systems, interprets their outputs, and applies human judgment to decisions that artificial intelligence cannot make alone. Success will hinge on strong governance, human oversight, return on investment discipline, and building digital acumen that empowers talent and upskills their expertise in this artificial intelligence era. The great concentration and the real risks. As financial institutions deploy massive capital into artificial intelligence, a dangerous concentration is emerging. In 2026, the nascent technology may need to start footing the bill, with this maturation requiring a hard look at whether the market's heavy reliance on a few tech giants has created a dangerous single point of failure. The infrastructure supporting financial artificial intelligence depends heavily on a small number of cloud providers and model creators. If any of these critical infrastructure providers fails or makes a mistake, the ripple effects throughout the financial system could be catastrophic. This systemic risk represents the greatest regulatory challenge of the coming decade. Looking toward a transformed future in 2025 and beyond, financial inclusion will no longer be about simply assigning someone a bank account number. Instead, it will be about enabling them to seamlessly interact with the full spectrum of financial services, including transactional, savings, lending, and investment, all within a single, integrated experience. Artificial intelligence enables markets to bypass legacy infrastructure entirely, leapfrogging traditional financial infrastructure and redefining the very essence of what it means to be financially included. The future of finance in an artificial intelligence-powered world is not about technology for its own sake. It is about democratizing access to sophisticated financial services, reducing costs, improving accuracy, and enabling ordinary people to achieve financial security. The institutions that master artificial intelligence will thrive. Those that do not will disappear. The individuals who understand how to work alongside artificial intelligence will prosper. Those who resist will find their skills becoming obsolete. The transformation is inevitable. The question is only how quickly it unfolds and who captures the benefits.